Good morning, and thank you for joining us for this month's Amity webinar. Over the last year, our webinars have covered an array of topics covering practice management, financial planning philosophy, behavioral finance, and wealth management. Through our own research on these topics and discussions with advisors across the country, we see some consistent themes emerging, and we thought it may be of value for advisors to gain some insight into a few of these topics, and also get some views in this regard from one of South Africa's leading asset managers. Today, we are joined by Jaco van Tonder, the Advisor Services Director at 91 Asset Management. And we have asked Jaco to share some of 91's insights with regards to, firstly, the health of the financial advice industry, and more specifically, investment advice industry. Secondly, key trends influencing the business strategies of FSPs going forward, and pertinent questions then also advisors have in relation to portfolio construction. Welcome, Jaco, and thank you for joining us. Now, I want to start off by asking, there's a concern that due to increased regulations and changes in demographics in South Africa, and here I'm thinking about things like, affluent and high net worth clients leaving the country, or even the lack of growth that we have from an economic perspective, sort of has an impact on the pool of investable assets. Given your research at 91, how would you describe the health of the advice industry in South Africa?
Hi Marius, and it's good to be here. Thanks for inviting me. You ask a bit of a loaded question, and I guess there are many different ways of trying to look at various metrics to try and maybe illustrate or get a feel for what we think the health is. We track at 91, we track on an annual basis a group of around 30 to 40 advice firms across the country who we have selected based on the fact that we think they are a good representation of the wealth IFA market. So they're all investment advisor practices. We send them a questionnaire every year, and we ask them to complete a number of financial ratios for us. So they give us a whole host of breakdown numbers that comes from their financial practices' annual financial results. And when we look at some of those numbers, we actually get a reasonably good idea, if you look through the clutter, at what is happening financially. Because ultimately, the success of the industry will be defined by whether we can continue to run financially viable advice firms, and the trends in that regard. So I've brought along a couple of slides from that deck that we do every year. And so the first one I want to share with you is just kind of revenue growth. What are we seeing from a revenue growth perspective? So the income that advice practices are earning, this particular group that we are tracking. And so on the slide, you can see a 3-year history of how revenue growth had changed. And it's actually a breakdown of how many practices have been able to get either less than 5% revenue growth, between 5 and 10, between 10 and 20, and then more than 20. And strangely enough, even if we just look at the averages, we can see that the latest version of our review, which was 2021, still shows a year-on-year growth in revenue number of about 17%. And you can see that a fair number of advisor practices sit on either side of that 5 to 10 and 10 to 20% growth. So I think up to then, this data is probably around to the middle of last year, which will be 2022. Up to about the middle of 2022, from a revenue growth perspective, investment advisors actually appear to have had a fairly good run of it tactically. So the short-term message, if we just look at revenue growth, is that it doesn't look so bad. And that corresponds with our flow numbers on our own book as well. We've had decent flows from IFAs over this period of time, and it's really only been in the last 6, maybe 3 to 6 months that we're starting to see a bit of a slowdown also at industry flow level. We're starting to see the unit trust industry reporting fairly flattish flows outside of money market for the last quarter of last year, and actually a net outflow of about 5 billion if we exclude money markets, reported by the ASISA Unitrust statistics for the quarter to March this year. So I think if we do this review again at the end of this year, we might start seeing this revenue growth number changing a little bit. The other two slides I brought along, we can briefly touch on. The one is the one that's up now is about the average fee that advisors are charging. I often get this question, what is the right fee number?
Yeah.
You know, and actually the way to think about a fee number is you must think about a fee number in the context of a business model. And what we can see, and that's on the slide at the moment, is the breakdown of how many advice practices out of this 40 are in the different advice bands, like less than 50 basis points, 50 to 65, 65 to 80, and then kind of 80 basis points and all the way up. And the takeaway that I get from this is that there are two very clear clusters of fees. You get your family office businesses that really perform a wide range of services for very high net worth clients who are charging a premium, but there are not many of them. And people who had been charging in the 90 and 100 basis points and plus margin, but not offering a high net worth kind of value proposition, are starting to feel that their fees are under pressure. And so we can see on the financial review that we do how there's a clustering of fees now either side of 50 to 60 basis points. The average is still above 60. Average is around 65 basis points at the moment. But it's clear that there's some pressure, that advisors are experiencing pressure from clients. And I think that, again, if we think just about as a product provider and a platform, that's consistent with what we are seeing in negotiations with clients around our admin fees as well. So I think these are the two key drivers for me and the two key slides to look at. The average fees, which appear to be under pressure, and growth numbers, which were healthy until fairly recently, but are starting to, I think, in the next year, we're going to start seeing them slowing down a little bit.
Now, looking at research that's on the advice industry in the UK, we see that the independent advisors in the UK post RDR over the last 13 years have actually increased. Now, if we look at that, what does the typical FSP in South Africa look like? You know, if you look at demographics and things like that.
So we subscribe to a piece of research that's done by a consulting business that's actually not South African, who analyzes the entire FSCA database. And that's of every single advisor with every single advice corporate. And they do this over time to enable us to see some trends in the local advice industry. It's quite a good data set. So I brought along a couple of slides that I want to share with you from that data set, which I think illustrates what's busy happening at an industry total. So this would be wealth advisors, investment advisors, but this would be a very wide range of advisors. This would include advisors who work for banks and insurance companies, but people who are qualified to give investments advice. So the first one I want to look at is how many advisors work in small firms, less than 5 advisors in the business. And strangely enough, it's around 60% still in South Africa. So if we think about that just for a moment, it sounds more, definitely when I looked at it first, it was more than I thought it was. I thought we were maybe closer to 40% would be there, and the bigger corporates would be employing maybe 60%. But it's still bigger than 50%. But if you look at the comparator from 2014, which is 9 years ago, to 2022, actually it's 8 years in this data set, you can see a reduction from 64% to about 57%. So what and this again corresponds with what we're seeing in the industry, where some of the consolidators have been doing okay. I mean, if we think about some of the firms who have grown their bases quite a lot, companies like Efficient or companies like PSG, the kind of names that we all know about who've been walking around the market acquiring one-man practices and advice firms. So it's clear that they've had some success, that some of the smaller firms have chosen to throw their lot in with the really large firms. But still in South Africa, we are largely, I would say, a fragmented advice industry with well over 50% working in what I would deem to be an SME style of environment. So that's just from the size of advice business and how that's changing over time. So we're definitely not seeing this massive consolidation that everybody was talking about post-phase, and then it was going to happen post-RDR, and then I don't know what the next thing is post-COVID is going to happen. So I don't know when this big consolidation is. It's happening slowish, but it's definitely not happening at the speed which I think people often make out that they think it's happening. The second interesting slide I brought along for you from that data set is just tracking the number of advisors who are active in the market with investments. And we split them between those who work for banks and life companies as tied agents and people who don't work for banks and life companies who are more independently focused. And I show you there on the slide data going back to 2014. And you'll see that for most of 2014 until fairly recently, the South African industry has employed more agents with banks and insurance companies in the investment market than there have been independent advisors. Not massively so, but meaningfully, 1,000 to 2,000 extra if you compare them. And you'll see that what happened during COVID was that the independent line came down quite rapidly. Obviously, as I think smaller independents struggle to convert their businesses to the online-only world. Some of them maybe lapsed their advice licenses for a year or two until things normalized again. And so we saw this strange trend where the independent numbers reduced over COVID, but the tied agent numbers stayed fairly flat. But more recently, the numbers have reversed. So it's clear the independents are bouncing back post-COVID quite quickly, but the tied agent channels, I think, are still struggling with dealing with the overhead. They maybe resisted, or they were able to convert their business models to a post-COVID model earlier, but they're still having to adjust to the fact that there are lower investment returns, the market's not as buoyant, there are lower flows, all the pieces you spoke about earlier. That means that they need to run their channels a little bit more lean. So I think we're seeing a slight decrease in tied at the moment and a slight uptick in independent, but no massive movements. And the movements are kind of all off a base that stayed quite stable in the last 7-8 years. And then the final slide I want to share with you, which is also a slide about the kind of demographic split of investment advisors in South Africa. So what I've got there is some data from an external source as well as from our own investment platform that gives you a split of advisors by age band. And so you can see there in kind of 10-year age bands, as expected, the 45 to 55-year-old band is the most popular one. But we have a lot of advisors on either side of those bands. So I don't subscribe to the theory in the investment advice market that we have this massive shortage of younger advisors who cannot take the place of older advisors. And we'll probably talk about succession a bit later, but it looks as if the market's quite healthy. I mean, that population pyramid on that graph is very healthy. You've got a good number of older advisors who are still in the industry and working, and you've got a good number of younger advisors from age 25 coming through the system with reasonable asset books. And only one point I want to make for the viewers on this one is, and we'll touch on that in a moment with the succession conversation again, I'm sure, but have a look at how many advisors there are still operating older than age 65. As a matter of fact, 50% of advisors work beyond age 65. And actually, a surprising number of them work beyond age 70. And I'll share this little tidbit with you. When I did this slide, I had a look at the oldest active advisor on our book who had a valid FSP license, who had clients and was earning a fee off of those clients for advising them. 91.
No way.
So there is an advisor out there somewhere. So for those of you who were worried that or thinking that you're going to retire by age 60 and by 65 you're going to be long gone from the industry, think again. I think advisors are clearly working for a lot longer than I think the often quoted consensus would be.
Sure. That is an interesting implication. I'm just thinking, a lot of advisors do not want to necessarily adapt to sort of the new type of philosophies, incorporating behavioral finance into the planning process and things like that. Yeah, exactly. But now all of a sudden, saying, well, maybe he's still about 90, then all of a sudden it becomes a different story.
And I think we need to think in the succession debates as well. We need to think really smartly about when people retire.
That's fascinating. Moving on to the topic of some strategic trends that is affecting the business of advisors. Now, one of the topics that will usually come up is fees and obviously remuneration models, and it links back to what I've just mentioned, with how do you adjust your value proposition and your planning proposition. What changes, if any, do you see, and what are the drivers of change? And then also a third question there is, where do you see the industry going with regards to fees and remuneration models?
So advice fees and how you pay for advice is, I think, going to be the next big revolution in the industry globally. And I say that because it's a debate that is catching on like wildfire. It's a debate that's raging in the US. It's got its almost religious cult-like followers, some business models and some ways of charging for advice fees. There are very strong opinions. And that's a classic example of when a wave is busy starting that could potentially change the way in which we operate as an industry. So I think if we look at the South African environment, maybe just for a moment, increasingly I'm finding advisors who have built existing good high quality practices based on basis point AUM fees, talking to me about introducing an additional advice model in their practice whereby they charge for advice on a rand fee basis, whether it's paid on a monthly basis or paid on a delivery of a plan or whatever the case might be. It's clear that people's thinking are starting to expand. And I think what is driving this development is to a large extent the younger generation, firstly, we have all been preaching to save for retirement and make sure you start saving early, and that message is actually landing. And so these people are coming to advisors saying that I want to start an investment of 500 or 1,000 rands a month, or I want to increase my contribution to my retirement fund by taking out an additional retirement annuity. And so, but I can't, there's no big product sale on day one, maybe. Yeah. I mean, unless it's someone who's gotten married or has kids now and they need to get some life cover. But often these engagements are engagements where there is no obvious product sale at the end of that chain. So business models where we remove the payment from the product sale are increasingly going to be in demand. And we need to start thinking creatively about how we can enable that. Now, this is not a session to talk about all the complexities in those models, because I think for any advisor considering moving away from an AUM model to a more fee-based model, my only comment is that be careful of the complexities, think really carefully about this and talk to other advisors who've done this before. There are ways to do it, but you need to sidestep some potholes in the process. So that would be my advisor message. My message to product providers would be that we need to be much more flexible in the way that we allow advisors to charge fees on our products. So the concept of all fees having to be a percentage of assets or flow, I think, is rapidly aging. And we need to start thinking about allowing advisors to charge specific rand-based fees, for example, or once-off rand fee deductions. We need to think in this new world, we're going to have many different fee combinations and permutations, and which of those can we accommodate through our existing product provider community. But it's a fascinating debate. I mean, I would encourage people to read up on this and see what the topics and the debates are like in the US, especially in the US. There's almost a cult-like following for this fee for advice business model in the US. And there are very few advisors in SA that have converted. I've known of a handful of practices that have decided as a matter of principle they want to move to this fee for advice model. And I think they've struggled along the way to get it all implemented. But I'm getting definitely more questions from advisors who are saying they want to offer it as an alternative fee model. So I think it's growing.
It's interesting what you say. We engaged with a consultant from Australia recently, and when we discussed fees, he was quite surprised that our platforms don't allow for something like a retainer, a fixed monthly retainer type of thing, etc. And that and obviously that would facilitate this. The other thing that this would contribute to is that if you look at the advice gap, if you look at the research, there's been a report recently from the UK research that has been done there that spoke about the big chunk or the big market that is a potential market for advisors with a good planning proposition to grow their businesses substantially. But as you said, most probably we need to think about how that service model needs to work.
I think, the classic example you're talking about now are clients who are income rich but asset poor. So these are people with highly qualified positions and jobs that pay and earn a big salary, but who have not accumulated a lot of assets because they're busy paying off a house and they're in debt and whatever the case might be. Now, strangely enough, if you look in the US again, and this is research I stumbled upon that was done at Kitses.com. Old Michael Kitses is quite a doyen on any topic financial advice related in the US, where they've done some work on trying to establish the willingness of clients to pay an ongoing retainer fee for advice as opposed to this basis points of assets. And they've come away with a realization that most people who earn a salary, who have a reasonable income but low assets, are willing to pay 1 to 2% of their income a year to financial advice. So if you think about this, someone, if a young household earns R1 million a year, they would be willing to pay between 10 and 20,000 rands a year for advice. And that starts approximating what we charge on the basis points model. If I look at our data from the Financial Review, most basis point model fees, the result of that is that clients are paying somewhere between 20 and 35,000 rand for most advice practices in that group of 40 that we look at. So you already approximate now with a retainer fee, you can approximate the income that you would be earning from someone's assets, but you can start earning that income a lot earlier.
Yeah, fascinating. Okay, that brings us to another very prevalent topic today, and that's about succession planning. Now, given that the average age of advisors is above about 55 or 50 plus, let's say, and the fact that many of them are, as we just mentioned, one-man businesses. So what kind of succession strategies do you see in the market or in the industry?
You and I can do a whole 2-hour slot, I think, on succession. So succession remains a critical discussion point for advisors, and it has been a topic that's come across my desk on a regular basis, probably for the last 5 years. I think what changes over time is the models that are the popular ones that people are investigating at any point in time, and I think that is maybe worth touching on. So I brought you a slide along that I use on the succession workshops that I do right at the start to give people an overview of, if you think about succession, you must think about succession in terms of kind of broad bucket options that exist. And I plot them on a little graph that I show you there to tell you that the big trade-offs and the differences between different succession models is how long it takes to implement the succession model and how much control you as the advisor or the seller have over the process. And so I map on that little slide for you where the common succession options plot. So all the way on the right top, you sit with internal succession. You get a young person in, get them into the practice, grow them, mentor them, and they buy into the practice over time and they take over from the senior advisor. That is a 15-year story. So it takes a long time, but you can do it the way you want to. You've got full control. All the way on the other side, you've got the selling to the large corporate. And selling to a large corporate, you can pull it off in a year. I mean, if you really put your mind to it, you could sell at the right price to a large corporate quickly. But you've got no control over what happens to the practice after that. Once the corporate has bought the clients and they've paid you the last fees and you've left, they will go on with those clients based on their business model, and your business model will be a thing of the past. And in the middle, you get these options where advisors work together, they share a premises, maybe they merge so that they become a 4-advisor practice as opposed to a single advisor practice. So what I've seen before COVID, we had a couple of really high-profile acquisitions by large corporates at eye-watering multiples. And these, I think, got a lot of people interested in saying, maybe I should sell my business. Subsequent to that, I think people have cottoned on to the fact that some of those valuations were really big bull market valuations that had other considerations that were driving the price. They weren't just buying the advice revenue stream. There was a whole product plan behind it as well. And so they've realized that actually the businesses are not worth as much as those deals potentially indicated. And so what I've seen most recently is more focus on the discussion about a succession model that involves either a younger person buying into the business and taking over a 15-year period, or two advisors with equally sized businesses starting to talk about potentially merging their firms, with the option that if something happens to the one advisor, the other advisor is the succession plan. That's definitely kind of developed, I would say, in the last 2-3 years. It's been a complete swing, to the extent that actually when I get approached by advisors now who want to buy, and they ask us at 91 and they say, but can't you look through your book for some small elderly retiring advisors who would be keen to sell? I looked through that and I said, we've gone through all of these names and they've all indicated that they're busy with another plan. So it's like, if you're a buyer at the moment, it looks as if there are no sellers. And you are right, it's as if there's been a drop-off in the number of people who are willing to sell. And if they do want to sell, the valuations that they want are really large, which makes it difficult to, so very few deals are really, I think, happening at the moment.
So talking about the valuation, so what have you sort of seen or trends in terms of that, and the implications then for, you know, sort of retirement and things like that?
Well, I think and I touched on it on the previous point, that I think people are being disappointed with what they see the real valuations of the business is. And I think the real message that's busy landing for lots of advisors is a successful retirement plan where you want to sell the practice and go and do something else as the advisor. You want to leave the industry, retirement, that's your plan. You can't do that only by selling your practice. The value of the practice is simply not enough to replace the income that you've made from that practice all your life. You need outside assets in an RA or a property portfolio or maybe a share portfolio. So you need retirement assets and the value of your practice combined can maybe help you retire with the same level standard of living as you had whilst you were working. And then those advisors are the ones who can sell and walk away. The advisors who don't have sufficient assets outside the practice actually can't sell and walk away. They need a solution where they sell part of the practice but maybe still continue working in the practice. Someone else starts running the business, does the compliance, does the ops management and all of that, and maybe they become more of an advisor and maybe they spend only a half day doing that, but they can never really stop being an advisor because financially the numbers just don't work.
Okay, interesting. Given that Amity is a DFM, what is the status of the DFM industry in South Africa, and how does it compare to a country like, for argument's sake, the UK?
Yeah, so I think it's the right comparative. You're definitely picking the right country if you want to see where we are relative to. I mean, the UK arguably started the DFM trend post RDR, and the South African industry took off quite rapidly post that, and it's grown massively. So industry statistics are quite difficult to come by. So I think everybody in the market kind of tries to compile their own statistics based on the data that they've got. In our data, we think that the DFM market's about 500 billion in SA, which is significant. We think that the market share of the investment wealth industry in South Africa could be somewhere between 15 and 20%. And if we compare that with the UK, where the numbers are well north of 30, there definitely seems to be some runway left in the DFM market. It's definitely become a lot more competitive. I would say the days of one or two or three players dominating the market's long gone. You've got a number of established players who do a really good job and who all have substantial client bases. And based on the ratings we see and when we talk to them, it's clear that the value add from the DFM is highly appreciated by the advisor clients. And so I think it's a healthy business model that seems to be growing from strength to strength from our position. When we don't play in the DFM space as a player, but obviously DFMs are our clients and we provide mandates to them. And we think that they've brought a healthy professionalization of the investment process to the advisory market, especially for advisors who aren't in their hearts investment management orientated. They're more advice orientated.
And what is the typical profile of advisors that use DFMs?
So definitely the smaller firms who never sold themselves as investment managers are probably the prime client base for a DFM, because you get a professionalized investment proposition that you don't have to spend an enormous amount of time interrogating. Plus you get a good level of support for your client communications and your client documentation from the DFM, which is worth a lot. If you've got to compile on-point market commentary the whole time to keep clients informed of what is going on with their investments, I mean, that takes a significant chunk of people time and mental capacity. So practices who feel that they would rather spend that mental capacity and time on the financial planning component, and also create a bit of distance between the investment process and the financial planning process, are the ones where the DFM model fits like a glove.
And what kind of value elements are they looking for? Do they put the biggest value on in terms of the value proposition?
So we, NMG, we're a third-party consulting company, does an annual wealth survey in the advice industry in South Africa. And as 91, we're one of the sponsors of that survey, so we get all of the detailed feedback. Now, one of the sections that they talk to advisors about in the survey is they talk around the relationship with DFM and what are the decision-making criteria when you decide on which DFM fits your business. And it's clear that the kind of key drivers are very much around portfolio construction, the investment process that backs and the research process that backs the investments and the portfolio construction process, and then the service and support in terms of being able to deliver that message to the client in a friendly and a sensible way. That is the essence of the package. So the investment process that advisors feel comfortable with and that they feel would complement their advice process, together with the support from the DFM, is clearly where the focus is. And if you look at, is that being successful? In one of the other sections in the report, the NMG actually ask advisors to kind of rate their strength of relationships with different players in the industry, whose services they might use. And DFMs consistently rank as one of the top components where the strongest relationships exist. So I think advisors with long-standing, high-quality relationships with a DFM partner really value those relationships for the value that they add to the actual practice.
So when it comes to managing the wealth of clients, there are, and more specifically when it comes to portfolio construction, we also see some hot topics. One question advisors often struggle with is, given the changes in regulation, for instance, with regards to offshore investing and things like that, what is in your view, let's say the optimal offshore allocation for a South African client, and is there a right time to move money offshore, given that the rand is where it is?
So the offshore debate has got a couple of drivers for financial advisors, and there are a few pressure points that advice firms are experiencing under the offshore debate banner. And the first one is a function of the exchange control changes that happened last year. So I brought along a quick slide that shows the full history of exchange control in South Africa going back to 95. But really the focus point is what happened in the last year. And what happened in the last year, other than the fact that we had an increase in effective exposure, is that CIS unit trust mancos now have the same exposure as Regulation 28. Whereas before, mancos had a slight buffer over Regulation 28. So Regulation 28, the gap was 5% to 10% historically in South Africa. And the problem with eliminating that gap is now mancos with large balanced funds are running out of offshore capacity and have to close their offshore feeder funds. So the offshore feeder fund industry, unless the government reacts again and makes a change and increases the CIS limits to be higher, let's say to 50% and then 45% for Regulation 28, we are going to find a lot of South African mancos closing their feeder funds. So that's the one pressure point we're seeing, is that we could see a reduction in the number of feeder funds available, and people wanting exposure to certain fund managers might have to actually take the money offshore in their own personal capacity as opposed to being able to access it via a feeder fund. The second challenge we're seeing is that on life annuities, especially living annuities, many life licenses are also running into their capacity limits now, And that's mostly for two reasons. Firstly, it's because I think the rand is weakened, but also because there's been a big rush in living annuity portfolios to placing more money offshore. And so there's a big debate that's busy doing the rounds about what is the right amount of money to have offshore. That's why I'm sure you asked the question. So let's deal with that. Our research shows that the kind of right number is not, it's not a point debate. It's not, is it 37 or 38 or 32? There's a range of exposures that are sufficient. You can have anywhere between, I would say, comfortably 35 and 55% offshore for a South African client and still get a pretty good investment outcome that's pretty robust. There's not a massive difference between the outcomes in that range. And so we've found that many living annuity providers experienced advisors placing 60 and 70% of client assets offshore. And of course, that caused those living annuity companies to run out of capacity on their life licenses. And now they're starting to break and stop people from investing more than 45% offshore. And that's causing pressure points for some advisors. So there's definitely in the kind of restriction space, at product level, we're starting to see advisors having to kind of move around a little bit with some fancy footwork to get clients the offshore exposure that they want them to get. So that's the debate on offshore from a product wrapper perspective, and we've the debate about how much is the right number. It's a range. Specifically in living annuities, there's a subsection to that debate, which we've contributed to from 91 as well, and that's answering the question that is there such a thing as too much offshore for a South African living annuity pensioner? Is there such a thing? Does it exist? You know, we've always complained or spoken actually about, you know, what is too little, and how much should you have? But now for the first time, people are actually walking around with a question at the back of their minds, and they're being asked the question by clients, is there such a thing as too much offshore? And some of the work that we've done had shown that definitely in excess of about 55 to 60% offshore, the volatility of the currency starts to have quite a negative impact on the living annuity. So in living annuities, there probably is such a thing as too much offshore, and it's probably north of 55 to 60%. So if you stick a living annuity somewhere around 40 to 45%, which is what the allowance is, you're still pretty safe, delivering good value for the client, very close to the kind of optimal exposure, and you're not exposing the client to too much volatility risk. The last piece in the offshore theme I think I would highlight is when people think historically we've been on 30% offshore for asset swap for a long time. And clients have for a while, and advisors have gotten used to that number as probably being the appropriate number. And so all of our investment work and portfolio construction work, when you are dealing with only 30% of the portfolio offshore, all the modeling work indicates that 30% must be long only offshore equity. But if the number goes beyond 30, all of a sudden it's no longer the case. And I think a lot of firms have done this work, and we've definitely investigated it. And we've come to the same conclusion, is that if you push offshore exposure for a South African client beyond 30, actually what you need to start looking at are different asset classes for that. The first 30 is offshore equity, long only, doesn't have to be strange, don't have to hedge out the currency. It's very straightforward. Beyond 30%, you actually need to start worrying about the currency volatility, which starts now becoming a bigger problem in the portfolio, as well as other asset classes which maybe up to that point the model work doesn't prefer. So we're finding that hedging out the currency risk on further offshore exposure starts becoming a good strategy. So that would involve, for example, buying an offshore equity fund, but in a hedged share currency class where the currency is hedged out, and so the movement between the rand and the US dollar or the rand and the euro is reversed or cancelled out, and you're effectively buying the euro return or you're buying the dollar return. So that's one option. We're also finding that other investment strategies start becoming interesting. So you need to start looking at some of the higher octane fixed income strategies, some of the credit strategies, for example, and bond strategies start becoming, the modeling work starts picking those asset classes, but only beyond 30%. So I think what this is now challenging portfolio constructors with in South Africa is, if you're buying a multi-asset fund, it's probably okay, because I think your portfolio manager is buying the excess piece in the right way. But if you are a building block buyer who kind of purchases your equity and your fixed income, your offshore components separately, and then you construct your portfolios, you're going to need components that now look a little bit different than long-only offshore equity. So I think those are the key, I would say, talking points that the offshore debate has unearthed in the portfolio construction space in South Africa.
And the hottest topic of the hot topics is most probably hedge funds. How do you see hedge funds fit into portfolio construction, and what sort of considerations should advisors look at when incorporating that into their portfolios?
So hedge funds, I mean, the hedge fund industry in South Africa has come a long way. Some people would say that we have been way behind pioneering countries in the hedge fund space like the US for a long time, and I think the inclusion of some hedge fund strategies under the CIS unit trust regulation has gone a long way towards making these products more accessible and giving the public more comfort in terms of investing in them. So I think the inclusion of hedge funds under the CIS regulatory banner was a key moment for the industry to become more mainstream. Having said that, we, as 91, we have a hedge fund product, a long-short equity product that we run, and to see where this is going to go and in which direction the market is going to develop into next. But I would say that the hedge fund industry is still very much in its infancy when you compare it to the long-only industry. Far fewer strategies, far fewer players, and much smaller asset base. We think there's a space for it, but we think you can't just apply US thinking to using hedge funds in SA. We think that you need to be mindful of the fact that not all hedge fund strategies are implementable in South Africa because we've got a smaller market. So where there are capacity constrained strategies, you've got to watch out, especially if you're a bulk buyer as an advice practice and you want to potentially put a lot of money with a particular hedge fund strategy. Understand what proportion of that strategy's capacity are you effectively taking up now, and is there enough left for this fund to grow and to continue to perform. So I think in the US, where the markets are massive, you can easily have $1 billion or a $2 billion or $10 billion hedge fund. The same numbers in South Africa will be dramatically smaller. So I think that's a key piece to keep an eye on. The second piece is to be sure you're buying them for the right reason. And I want to touch on, I mean, we all are aware of the buying last year's winners syndrome. I mean, we've been doing this as an industry for as long as I've been in the industry, where in the unit trust long only space, the manager who did the best last year is the one who gets, most of the flow this year. So I think we need to be careful of falling for that trap. You buy a hedge fund for the fact that it produces return, but it produces uncorrelated returns and uncorrelated to the rest of your portfolio. So a hedge fund strategy has to make sense in the context of the rest of your investment portfolio. So don't buy a hedge fund just because it's delivered a good performance number. I think that would be the wrong reason to buy a hedge fund. And then the last consideration I would say you need to look at quite carefully is you need to think about fees. So especially in the current environment where fees are under pressure, we've seen it with the financial advisor fees, we're seeing it with platform fees, we're seeing it with Manco investment management fees. Most financial advisors are nowadays trying to construct investment propositions for clients where the total fee to the client with everything in comes in at around 2%. Now, hedge funds unfortunately do cost a little bit more. Many, if not most of them, have performance-related fees, which can push the fees up quite high. So making sensible use of your fee appetite in your product that you're constructing, I think, is important, and giving the right amount to a hedge fund and making sure that you monitor what the impact of those fees are going to be, and that the fee structures are fair. That the fee structures and the hurdle rates are fair relative to what the client is going to get, also in terms of the overall portfolio. So still, in summary, I think not a mature industry by any stretch of the imagination, and I think still an industry where we need to keep our eyes open if we include them in portfolios as portfolio constructors, but definitely something that we see as a continued growth industry for now. So definitely not negative about the industry.
Now, we've come a long way since the introduction of passive solutions.
Oh, the other hot topic.
The other hot topic, yeah.
For active
and
managers.
I would argue that it's not a debate anymore in terms of, whether you use active versus passive or whatever, but rather how to use it in constructing the portfolio. And what considerations do you see play a role in constructing portfolios, and when to use passive, when to use active?
So you're quite right. We're an active manager as 91. We don't manage any passive products. So let me just say that up front and state our position quite clearly about the business side. However, we do agree that there are times when a passive allocation in a particular portfolio construction process would make sense. I think there's a few things that you need to think about before you use passive in South Africa. So passive and the success of passive versus active varies a lot in different markets. In highly efficient, developed world economies, passive represent a significant threat to active managers in highly liquid equity mandates where there's lots of money, lots of liquidity, lots of trading, and where it is enormously difficult to consistently outperform the index. And we often see those statistics quoted on major US indices like the MSCI, for example, or the S&P 500. So clearly there, in those cases, passive present a viable return proposition that competes very well with active. However, in more developing markets like South Africa, where the trading is not as efficient, the markets are not as efficient, where there's lots of other interferences that affect the pricing of shares and securities, it's not as easy for passive to put up the same type of fight that they put up for active. You'll still get times when they outperform active, definitely, but it's from a pure investment perspective, investment performance perspective, it's not as clear-cut as it would be for developed markets. So that would be the first big difference. I think if you looking towards allocating to active or to passive rather, look towards allocating to passive in areas where the mandates are highly liquid, well traded, lots of volume, and where the ability to outperform for active is more difficult. And in the slightly lower liquidity, more inefficient markets all over the world, like South Africa, look very carefully at, rather whether the active opportunity doesn't present a better investment return. So that would be the first thing I'd look at. The second one would be, one of the big selling factors for passive is fees. And so it goes without saying that a passive fund has got to be fee competitive in that space. And many of the global passive big players, the fees are almost nothing. It's like incredible how low those fees are. So from a portfolio construction perspective, sometimes it could be the case that you've used your fee allocation or budget for some high juicy opportunities, which unfortunately tend to cost a little bit more. Whether that be some hedge fund strategy or whether that be some investment long only product that's limited in size, where the fee there's a capacity constraint, so the fee is a bit higher. So you've allocated some money to some juicy opportunities, and you need to be very careful with your allocation of the rest of the portfolio. In cases like that, a good quality passive at a very cheap fee can help you make your fee budget. No question about it. And so that would be the other consideration. And again, there are differences here because the more liquid the market, the more well traded the market is, and the bigger volume that goes through it, the cheaper people are able to offer passives in those markets, and the lower the trade and the more inefficient the market, the more the passive fee tends to creep up until it actually is not as good a deal as it would have been in the international market. So I think if you're looking at passive, you look at those two. You look at the probability for the outperformance and you look at the fees. And between those two, there are definitely clear-cut cases where they would make sense in an investment portfolio, even if you're constructing portfolios in South Africa. And we see that with many DFMs, there is a meaningful slug allocation to some passive portfolio somewhere in the mix. So I think to a large extent that's already happening, and we think it's happening for the right reason.
Jaco, thank you very much for an insightful discussion and helping us to get a feel for where we are in the industry. We really appreciate your time.
Thank you very much. I really enjoyed it. Look forward to the next one.